All right, welcome to our discussion on factor models. Now, in this series of 3 videos, I'm going to first talk about the theory behind the CAPM, and then in a follow-on video, I'll talk about how we use the CAPM in the real world, and then finally, I'll talk about something called arbitrage pricing theory, which involves us adding additional factors to the CAPM in order to increase the predictability or the prediction power of our models. So if you had me for 310, you saw a 3-factor model. In this section, you are going to see a 5-factor model. Okay, so this video, like I said, focuses on the theory behind the CAPM. So I'll start off talking about market risk. We'll get refamiliarized with beta and the CAPM, and then finally we'll use the CAPM to predict annual stock returns. Okay, now to get us started, we have a couple of different types of risk. You've undoubtedly become familiar with firm-specific risk. Sometimes we call this diversifiable or unsystematic risk. This is the risk that only affects the firm or maybe a few of its suppliers and buyers as well if they lose revenue because the firm goes bankrupt. This is the risk of, the classic example I like to give is a Chipotle E. coli outbreak. So if Chipotle food starts making everyone sick, nobody's going to want to buy food at Chipotle. Revenue falls, future cash flows fall, and the share price should fall because it's based on expected future cash flows. Now, this kind of risk can be reduced by diversification. You're going to see this in a few seconds. The other big type of risk we have is what's called market risk. And sometimes you'll hear this called undiversifiable or systematic risk. These terms are synonymous. Some people use these in the real world. That's why I mention them. You should know that systematic risk means market risk just in the real world, because in the real world, we just throw out these terms, just interchangeably. Now, market risk is the risk that you can't get away from. It's the risk of a global coronavirus outbreak or the risk of a meteor hitting the U.S. eastern seaboard. Yes, you might be less exposed to that risk, but you are still exposed and you cannot get away from it as long as you are investing. Now, this is the risk that you cannot diversify away. You can only be exposed to a little more or a little less of it. All right. Now, if you had me for 310, you've seen this chart. In my opinion, this is the most important chart in any investments class you will ever take. What this shows is the relationship between portfolio risk and diversification. So on the y-axis, I have the volatility of the portfolio, standard deviation, sigma sub p, and then I've got the number of securities in the portfolio here. So what I did was I pulled some data and then I just started adding securities to the portfolio and recalculating the volatility of that portfolio. What you can see here is that as you add securities to a portfolio, the risk falls tremendously, down to about, this red line, obviously. It's quite frankly, once you get to about 20 to 25 stocks, the amount of volatility you're reducing by adding an additional stock is pretty marginal. And the reason I show you this chart is, quite frankly, because it perfectly illustrates the value of diversification. But it also shows you the breakdown in firm-specific and market risk. Everything above this red line would represent firm-specific risk. Everything below this line would represent market risk. Notice that by diversifying, you're significantly reducing your firm-specific risk, your risk of an E. coli outbreak at Chipotle. But you'll never be able to diversify away this market risk. And because you cannot diversify away this market risk, this is the risk that you should demand compensation for being exposed to. So this is why we say the more market risk you're exposed to, the higher your return should be, the higher the return you should demand as an investor. So to put this in one sentence, which I like to do, when our portfolio is well diversified, we worry less about firm-specific risk, and we start to focus more on market risk. Now, this is the entire idea behind the CAPM and beta. But basically, if we've got a well-diversified portfolio, which we should, really the only factor we should care about should start to be our market risk. And the way that we proxy for our market risk is through beta. Beta is our best measure of market risk of an asset. What it does is it quantifies this market risk based on historical data, and we calculate beta using simple linear regression. So what you're looking at right here where my cursor is, this is just our capital asset pricing model that you've seen in at least 2 classes, hopefully more by now. Beta is it's essentially the slope in a simple linear regression. That's how we calculate it. So to refresh your memory, the CAPM, this is just the return on a stock equal to the risk-free rate on, the yield on a T-bill in the US, plus our beta times the return on the market minus the risk-free rate. Now, betas are incredibly important when we build portfolios. The reason we care so much about them is because, well, quite frankly, if we're diversified, we shouldn't really care that much about the individual risk of a firm or a stock. And so betas kind of become our best risk measure when we build a portfolio. So when you are building portfolio, I generally recommend having at least 25 to 40 different individual stocks. And, once you have that, you can start to focus primarily on the beta of the stocks. If you want a higher expected return, but more volatility, you could increase the overall weighted average beta of the portfolio. If you're risk averse, you might hold stocks with low betas. All right. Now, a couple of points that you should know about beta. First, beta measures the market risk. I guess I've already said that a couple of times, but it should be the first thing you think of when you think of beta. It's a proxy for the market risk of a security or a portfolio. Next, beta, it tells us how sensitive that firm's returns are to changes in the market. So in other words, I have this example, if the market is expected to increase by 10% or have a 10% return, a stock with a beta of 1.5 should have an expected return of, let's say, 15%. Assume we have a 0% risk-free rate like we did for a long time in the US. So basically, higher beta, more sensitive stock. The beta of the overall market, however, on average is 1. If you were to just calculate the beta of the S&P 500, well, quite frankly, you're regressing the S&P 500 return on the S&P 500 return, so you'd get 1. Now, betas of greater than 1 indicate that we have essentially a cyclical stock, a stock whose returns are going to be very good during bull markets or, growth periods of the business cycle, and then these stocks with beta of greater than 1 will underperform during recessionary periods. Betas between 0 and 1, these are typically stocks that are in very, very stable industries that are kind of insulated from the business cycle. So basically, you've got less than the average market risk. A good example that I like to give out would be Walmart or Kroger, any grocery store, any store that's selling goods or services that everyone's going to need regardless of how the market is doing. That firm is probably going to have a stock with a beta of less than 1. Now, there is a function out there that we can use to look up betas. It's called literally just the beta function in Bloomberg. We are absolutely going to use this in class a lot. All right, now I did want to give you some actual betas. So I pulled this data, summer of 2024. So let's just walk through this. So a couple things I want to point out here. First off, industry pairs. So industry pairs will typically have similar betas. So we have GM and Ford here. They're both in the auto manufacturing industry, and that industry is quite cyclical. I mean, they sell more cars when people have disposable income, so they should have betas of greater than 1. Next, we have Apple and Google. And unlike most tech stocks, or other big tech stocks like Nvidia or Netflix, Apple and Google are pretty well diversified. And so when you have a well-diversified company, that company's often going to have a beta of close to 1. Most tech stocks, though, are typically going to have very, very high betas, so betas of significantly greater than 1. Next, we have Walmart. Like I said, defensive stocks or stocks of grocery stores are typically going to have betas of less than 1, and this is the best evidence I can give you. Companies like Walmart would be seen as defensive stocks. And then we also have airlines. Airlines are really the opposite of defensive stocks. I mean, I think American has defaulted on its debt at least twice in the last 30 years. So airlines, they're very cyclical, and so they have very high betas. Banks, because they're very diversified, or they make loans to a lot of different industries, your biggest banks that are federally overseen by the FDIC, they're typically going to have a beta of close to 1. And then finally, we have a couple interesting things here. So GE, big company, industrial, that could either be greater than or less than 1. I'd expect a beta of something like 1.2, to be honest, though. Then we have some poor performers. GameStop. I mean, GameStop it's been circling the drain for quite a while. I like to show what a company that's close to default has in terms of a beta. I've updated these slides more times than I care to count, and almost every year I do have to update this particular line because whatever stock I put here probably is about to default. So I've had Sears here, it had a negative beta the last time I had it in before it defaulted. JCPenney I had for a while, negative beta. A couple others here, but yeah, some of these companies that are poor performers, they have very negative returns when the S&P 500 has positive returns, and so therefore they're going to have negative betas. And then gold will typically have a low or a negative beta as well. Okay, one final point before we get into the CAPM. If you have a bunch of security betas, like stock betas, you can actually calculate a portfolio beta. Basically, your portfolio beta is just the weighted average beta. Just take your weights at the beginning of the period, multiply them by your betas, sum up those products, and there you go, portfolio beta. The same is also true for alphas. All right, now, finally, we introduce the CAPM. Now, the CAPM is, it's one of the most important models in all of finance. I know you've seen this before in multiple classes. If you didn't have me for 310, you might be unfamiliar with this term, the model form of the CAPM. The model form of the CAPM is the form that we always see in textbooks. It basically just says the expected return on a stock or a security is equal to the risk-free rate plus the beta times the market risk premium, aka the expected return on the market minus the risk-free rate. Now this is the one that we use to predict stock returns and portfolio returns if we have a beta and this other information. There is another form called the regression form, which we actually use to calculate our beta and eventually our alpha. So we'll talk about that regression form in a second, but I do want to mention a couple things here. The most crucial thing here, and this is something that I've seen every semester I've ever taught, students will inevitably get this entire thing confused. This entire thing in the parentheses is our market risk premium. A lot of people will just call this the return on the market, and they'll always get a question on an exam wrong. The expected return on the market is just this first period, this first thing, this XE of R sub M. The market risk premium is the amount by which the market is expected to outperform the risk-free rate. So if you see that on an exam, make sure you do not confuse the expected return on the market with the market risk premium. Every year, I see people missing that question in 310 and also 410. So just don't let it be you. All right. Just a very, very basic CFA question. Which of the following is most likely to have an expected return less than the risk-free rate? An asset with a beta of negative 0.25, an asset with a beta of 0, or an asset with a beta of 0.25? Well, correct answer here is absolutely going to be A. Why? Well, because if you have a negative beta and the market return is expected to be positive, essentially that's going to make this entire part of the equation negative, and so your expected return should be less than the risk-free rate. Okay, a couple additional basics that you should know about the CAPM. The CAPM, I know I keep saying it's a very important model. Even by saying that, I'm kind of understating how important the CAPM is. The CAPM is arguably our most important model in investments. It's an equilibrium model that kind of underlies all of investment theory. There's something out there that if you ever do a master's in finance or really get into investment theory, you might hear this term, the fundamental pricing equation. The CAPM is kind of like this usable form of the fundamental pricing equation. It underlies absolutely everything. It basically just says more risk should be justified by more return. Now, in order for the CAPM to work, we do have to assume that we are building a diversified portfolio. In other words, we do not have market risk, we do not have firm-specific risk. There are a lot of big assumptions that we have to make. Other things that are probably noteworthy when we talk about the CAPM, the CAPM was developed shortly after the modern portfolio theory was developed. So MPT comes out in 52. In the mid-60s, that's when we start to see several different researchers come up with this fundamental pricing equation and the CAPM. So a lot of researchers are credited with developing this. Here are some of the names, but ultimately several people won the Nobel Prize for developing the CAPM. Now, the CAPM's used all over the place. We'll use it pretty much every day of our class going forward when we do our stock valuations, and we often want to use it in corporate finance as well. It's one of the key components in the weighted average cost of capital. It's often used in capital budgeting. This thing is all over the field of finance. Now, there are a couple of key assumptions that we have with the CAPM. I just highlighted 3 here, and I think they're the most important 3. They're really the 3 that you should remember. First off, the CAPM assumes that markets are efficient and information is priced. The reason we need to assume this is if we have efficient markets, then the price of an asset is going to be is going to reflect new information. So as soon as new information comes out, that information is going to affect the share price of the stock. So bad news comes out about the firm's expected future cash flows, the price of the stock will fall. Now it's more risky, and if you want to take on that particular stock, you should be able to get a higher future expected return. Next assumption, when we work with the CAPM and most of these equilibrium models, we're generally assuming that there are no market frictions. There's no transaction costs, there's no taxes. Obviously, that's not true in the real world. We do have taxes. We have capital gains taxes, we have dividend tax rates, we have all kinds of other taxes. In some countries, they have trading taxes. Quite frankly, there's a lot of market frictions out there that we're just assuming away when we develop the CAPM or talk about it theoretically. But in the real world, we do have to deal with these, which makes it a bit problematic. Finally, the CAPM assumes that all investors can invest in the same assets. Again, that's not true. Mutual funds are typically limited to liquid assets, stocks, bonds. They typically can't invest in junk bonds. So what they typically do will increase their holdings of equities. Some investors cannot invest in certain markets. If you want to invest in, let's say, the Botswana stock market, there's not many brokers that are going to let you do that. So there's a lot of cases where investors cannot invest in the same assets. Okay, so let's take a look at another CFA level 1 type question. So given that the expected market risk return is 7% and the risk-free rate is 2.5%, what is the expected return for Daniel's security? Well, whenever we see this term expected return, the default should be to use the capital asset pricing model. Now, with the CAPM, we don't use the standard deviation. CAPM only estimates the expected return based on the security's market risk. And for market risk, we use beta. So here, we just kind of plug in numbers for risk-free rate, beta, and expected return on the market. So here, risk-free rate, probably yield on a T-bill, 2.5%, beta 1.6, market return of 7%, and then our market risk premium is just everything in these parentheses, 7% minus 2.5%. Ultimately, we get an expected return of 9.7%. Okay, one of the last things I do want to talk about is the security market line. Very basic concept when we talk about CAPM. This is something that, you're not going to be building the security market line in the real world, but it's one of those definitions that you do need to know because you kind of look like a fool if you don't know this. So the security market line is a graphical interpretation of the relationship between the market beta and the expected return. Basically, I like to phrase it, it's the picture of the CAPM. It shows this relationship between risk and return, and here it is. So let's say we had a risk-free rate of 4%, and we wanted to see what the expected return is for a given level of market risk, aka beta. Well, as you can see, as our market risk increases, we should expect a higher return. If this was corporate finance, we would say we would demand a higher return in order for being investors. But quite frankly, what you can see here is that, if we, let's say, have a beta of 1 on an asset, then our risk premium is just the difference between the return and the risk-free rate. So here our risk premium is 6%, our expected return is 10%, and then as our beta goes up, our expected return will also go up. All right, so one final question. Which of the following is most likely to be the primary determinant of the expected return of an individual asset in the CAPM? Is it the asset's beta, the asset's standard deviation, or the asset's risk premium? Well, the correct answer here is absolutely going to be A. Every asset that has regular returns, we can calculate a beta for. The CAPM doesn't use the standard deviation, so B isn't going to be correct. And then the asset's risk premium, generally when we talk about risk premiums in the CAPM, we're talking about the market risk premium, and that's going to be the same for every asset. So correct answer, A. All right, so let's summarize. Market risk is proxied by beta. It's the most important risk we have in investments. The larger the beta, the more market risk the security or portfolio exhibits, and we should demand a higher return for those securities or portfolios with high betas. The CAPM shows the relationship between the stock return, the expected return, and the risk-free rate, beta, and the market risk premium. And then lastly, we took a look at the SML, the security market line. That's just our picture of the CAPM. So with that, I'm going to conclude. And if you have any questions, please feel free to reach out. Thank you.